They waited until the holiday season. Classic timing, really. While most traders were focused on year-end positioning and family gatherings, something fundamental shifted in global materials markets. The headlines screamed about a $34 billion emergency, about silver prices crashing from record highs, about banking system stress and margin calls gone wrong. But the real story, the one that changes everything, appeared to be unfolding away from public trading narratives, not on trading floors in New York or London. This discussion is for educational and analytical purposes only and does not constitute financial advice. Friday morning, December 27th, silver touched $82 per ounce. By Monday afternoon, it had collapsed to $61.50. The financial media called it profit-taking. They blamed holiday liquidity. They pointed to margin requirement increases from the Chicago Mercantile Exchange, standard explanations for what appeared to be standard volatility, except the scale and speed of the move challenged conventional historical comparisons. While algorithmic trading systems were executing massive sell orders and clearing firms were issuing margin calls, procurement managers at technology companies across 3 continents were making phone calls that revealed the actual state of global materials supply. These weren't calls about price. They were calls about availability, the kind of calls that suggest markets have crossed a threshold into something structurally different from prior cycles. The $34 billion Federal Reserve intervention was real. The banking stress was real. The margin liquidations were real. But these were symptoms, not causes. The cause sits much deeper in the structure of how modern civilization consumes the materials it requires to function. We've entered a phase where the physics of scarcity begins to override the mathematics of finance in certain critical industrial inputs. What happened to silver over the past week represents more than a commodity rally and correction. It represents the moment when decades of gradual industrial change collided with the hard limits of geological supply. The price action was just the surface manifestation of a supply chain that has quietly transformed from abundant to constrained under evolving technological demand. The technology driving this transformation has been hiding in plain sight for years. Research laboratories have understood its potential. Manufacturing engineers have refined its applications. But markets have continued to price the underlying materials as if nothing had changed. That disconnect has become increasingly difficult to reconcile. The breakthrough reshaping global materials demand emerged from the development of advanced battery chemistry, specifically the integration of silver-carbon composite anodes in next-generation energy storage systems. This isn't theoretical research anymore. Major manufacturers have confirmed pilot production lines. Automotive companies have published specifications. The technology has moved from laboratory curiosity to industrial reality within a compressed development timeline. Traditional lithium-ion batteries suffer from a fundamental limitation called dendrite formation. When charged rapidly or repeatedly, lithium ions create needle-like crystal structures that eventually pierce the battery separator, causing thermal runaway and fire. This is why electric vehicle charging takes 45 minutes. This is why battery packs lose capacity over time. This is why energy storage systems require complex cooling and safety mechanisms under current designs. The solution involves incorporating silver into the battery's anode structure as a nanocomposite layer. Silver acts as a host material that allows lithium ions to deposit evenly, preventing dendrite formation entirely. The result is a battery that charges in minutes rather than hours, lasts twice as long, and operates safely at temperatures that would destroy conventional cells according to published laboratory and pilot-scale data. Samsung SDI, one of the world's largest battery manufacturers, quietly confirmed production specifications for their solid-state battery line last month. Toyota has announced commercial deployment targets for late 2026. Volkswagen has allocated billions for manufacturing capacity. The technology has reached the point where automotive companies are committing to production timelines measured in months, not years, as disclosed in public statements and filings. The critical detail that markets have overlooked is the amount of silver required. Traditional batteries use silver in trace quantities for electrical connections and control systems. A typical electric vehicle contains perhaps 30 to 50 grams of silver total. The new battery chemistry requires silver as an active component in every cell of the battery pack rather than solely as a conductive accessory. Early technical papers suggest silver loading requirements between 5 and 10 grams per kilogram of anode material. Conservative estimates put the total silver requirement at 100 grams per vehicle. More aggressive performance targets could require 300 grams or more. For perspective, this represents roughly 10 times the silver content of current electric vehicles based on present designs. Global automotive production approaches 90 million vehicles annually. Electric vehicle market share continues expanding toward mandated targets of 50% or higher by the end of this decade. If solid-state battery adoption reaches even 20% of electric vehicle production, The automotive sector alone would consume approximately 100 million ounces of silver annually under current technical assumptions. This represents a step function increase in industrial silver demand. Not gradual growth, but an immediate doubling of consumption from a single application. The solar industry, which already consumes over 200 million ounces annually, continues expanding at rates exceeding 30% per year. Electronics manufacturing requires increasing silver content as devices become more sophisticated. Data centers supporting artificial intelligence applications consume vast quantities of silver-intensive components as processing density increases. The math becomes stark when viewed against available supply. Global silver mining produces approximately 830 million ounces annually. Recycling contributes another 180 million ounces. Total supply of roughly 1 billion ounces faces existing demand already exceeding 900 million ounces. The structural deficit has persisted for 3 consecutive years, drawing down inventories across all major storage facilities according to industry reports. Adding 100 million ounces of automotive demand to an already constrained market creates what materials scientists call a supply-demand inversion. Demand grows faster than supply can respond, inventory buffers disappear, and price becomes increasingly disconnected from production costs. The system enters a regime where availability, not price, becomes the primary constraint for certain industrial users. Mining companies cannot simply increase production to meet demand. Silver deposits require 7 to 12 years from discovery to commercial production. Existing mines face declining ore grades and increasing extraction costs. Political instability affects major producing regions including Mexico and Peru. Environmental regulations complicate new project development. The geological reality is that silver supply responds slowly, if at all, to price signals within typical planning horizons. Recycling faces similar constraints. Unlike gold, which concentrates in jewelry and coins that can be easily recovered, silver disperses across countless industrial applications in quantities too small for economic recycling. Solar panels contain silver in thin films that cost more to extract than the recovered metal is worth. Electronic devices contain microscopic quantities spread across dozens of components. Battery recycling won't provide meaningful supply for at least 15 years, as current battery installations haven't reached end of life based on average vehicle life cycles. The supply response timeline creates a dangerous mismatch. Automotive companies need silver starting in 2026 to meet announced production targets. Mining companies need until 2035 or later to bring significant new supply online. The gap between demand emergence and supply response guarantees years of structural shortage unless major technological substitutions occur. Historical precedent suggests how markets behave during such transitions. Palladium experienced similar dynamics in the early 2000s when automotive companies shifted to palladium-based catalytic converters. The price increased from $200 to over $3,000 per ounce as industrial users competed for limited supply. Rhodium saw even more extreme movements when emissions regulations tightened, reaching over $29,000 per ounce at peak shortage according to historical pricing data. Silver's situation differs in scale and scope. Palladium and rhodium serve specialized applications with limited substitution possibilities. Silver has become essential to multiple massive industries simultaneously. The solar transition requires silver. The electric vehicle transition requires silver. The data center expansion requires silver. The military and aerospace industries require silver. Unlike niche metals, silver supports the foundation of the modern economy across civilian and industrial sectors. Markets historically misprice structural transitions because they rely on linear projections from historical data. Algorithmic trading systems execute based on technical patterns and momentum indicators. Financial analysts model demand growth using regression analysis of past consumption. These approaches work well during periods of gradual change, but fail catastrophically when underlying consumption patterns shift abruptly outside modeled assumptions. The margin requirement increases from the Chicago Mercantile Exchange reflect institutional recognition that traditional risk models no longer apply under heightened volatility conditions. When physical shortages emerge, futures markets become disconnected from underlying reality. Leveraged positions amplify volatility beyond historical norms. Clearing firms face counterparty risks that standard margin calculations cannot capture during supply-driven dislocations. The $34 billion Federal Reserve intervention suggests stress within the banking system's commodities trading operations as reported through emergency liquidity facilities. Large financial institutions maintain substantial short positions in precious metals as part of their market-making activities. When prices move beyond expected ranges, these positions generate losses that require emergency funding to maintain solvency under existing regulatory frameworks. Market participants find themselves caught between contradictory signals. Technical analysis suggests the rally has overextended and correction is inevitable. Fundamental analysis indicates structural shortages that could persist for years. Traditional relationships between precious metals, currencies, and interest rates no longer provide reliable guidance. The cognitive dissonance creates the kind of confusion that typically accompanies major structural transitions in complex markets. Skeptics point to silver's historical volatility and question whether current demand projections will materialize. They note that technology adoption often proceeds more slowly than initial projections suggest. They observe that high prices typically encourage conservation and substitution that reduces demand growth. These arguments have merit based on historical precedent, but they assume that silver remains a discretionary input that can be optimized away without performance trade-offs. The reality of advanced battery chemistry suggests otherwise. Silver's role as an active component in electrochemical processes cannot be easily substituted without sacrificing performance. Automotive companies face regulatory mandates for electric vehicle adoption that leave little room for delay or compromise. The transition has moved beyond market preference into regulatory requirement, creating inelastic demand that persists regardless of price within mandated frameworks. The psychological pressure on market participants continues intensifying as the gap between financial pricing and physical reality widens. Trading firms that built business models around abundant supply now face the possibility of being unable to fulfill delivery obligations. Industrial users accustomed to just-in-time procurement discover that the materials they require simply aren't available at any price within required timelines. This divergence between paper markets and physical markets historically resolves through violent repricing events that force financial positions to align with material reality. The process typically involves cascading liquidations, delivery defaults, and emergency interventions by regulatory authorities. The $34 billion weekend suggests this process has already begun in early stages. The structural changes driving silver demand have already influenced real-world industrial decisions, even as public pricing systems struggle to reflect new realities. Manufacturing companies are securing long-term supply agreements at prices significantly above current market levels. Automotive executives are redesigning production schedules around materials availability rather than consumer demand. Government agencies are treating silver as a strategic material subject to export restrictions and stockpiling requirements as part of broader industrial security planning. These decisions reflect an understanding that the materials landscape has fundamentally changed, regardless of what financial markets currently suggest about pricing. The physics of scarcity operates independently of the psychology of trading. Materials either exist in sufficient quantities to support industrial requirements, or they don't. The mathematics of supply and demand ultimately override the complexity of financial engineering over extended time horizons. The real crisis wasn't the $34 billion emergency injection or the silver price collapse from $82 to $61.50. Those were just the visible symptoms of something far more fundamental. While financial media focused on margin calls and banking stress, procurement departments across the global technology sector were discovering that the materials they assumed would always be available simply weren't there anymore within expected delivery windows. China's announcement on December 28th changed everything, though few understood the implications immediately. Beginning January 1st, all silver exports from China would require government licenses. Only state-approved companies meeting minimum production thresholds of 80 tons annually could participate. The policy effectively eliminated hundreds of smaller exporters who had supplied global markets for decades, according to published trade guidelines. The timing was surgical from a market impact perspective. China controls between 60 and 70% of the world's refined silver supply. Their October exports had reached record levels of over 660 tons, much of it flowing into Western storage facilities as Chinese companies front-loaded shipments ahead of anticipated tariffs. That flow just stopped as licensing requirements took effect. But the export restrictions were merely the trigger for a crisis that had been building for years beneath the surface of global materials markets. The real transformation-driving event stems from a technological breakthrough that has quietly moved from laboratory research into commercial production. The breakthrough involves the integration of silver into advanced battery chemistry in ways that fundamentally alter how much silver modern civilization requires to function at scale. This isn't gradual industrial evolution. It represents a phased transition where decades of incremental technological progress suddenly converge into immediate materials requirements that existing supply chains cannot support. The silver market has crossed a threshold into a regime where availability, rather than price, becomes the primary constraint on industrial production for multiple critical sectors simultaneously. The technology reshaping global silver demand emerged from solving a persistent problem in energy storage. Traditional lithium-ion batteries suffer from dendrite formation, where rapid charging causes lithium ions to create needle-like crystal structures that eventually pierce the battery separator. This limitation forces electric vehicles to charge slowly, reduces battery lifespan, and creates safety risks through thermal runaway under high-load conditions. Researchers discovered that incorporating silver into the battery's anode structure as a nanocomposite layer eliminates dendrite formation entirely. Silver acts as a host material that allows lithium ions to deposit evenly across the electrode surface. The resulting solid-state batteries charge in minutes rather than hours, last twice as long as conventional cells, and operate safely at temperatures that would destroy traditional battery packs based on validated test data. Samsung SDI confirmed commercial specifications for their solid-state production line in late December. Toyota has announced deployment targets for automotive applications beginning in 2026. Volkswagen has committed billions in manufacturing capacity. The technology has moved beyond pilot programs into industrial scaling with production timelines measured in months rather than speculative projections. The critical factor that markets have consistently underestimated is the quantity of silver required. Traditional electric vehicles contain 30 to 50 grams of silver in electrical connections and control systems. The new battery chemistry requires silver as an active electrochemical component in every cell of the battery pack. Technical specifications suggest loading requirements between 5 and 10 grams per kilogram of anode material under current designs. Conservative estimates indicate total silver requirements of approximately 100 grams per vehicle for standard range applications. High-performance configurations requiring larger battery packs could demand 300 grams or more. For perspective, this represents a 10-fold increase in silver content compared to current electric vehicle designs currently in mass production. The mathematics of this transition becomes stark when projected against automotive production volumes. Global vehicle manufacturing approaches 90 million units annually. Electric vehicle market share continues expanding toward mandated targets exceeding 50% by the end of this decade. If solid-state battery adoption reaches 20% of electric vehicle production, automotive silver consumption would increase by approximately 100 million ounces annually based on conservative adoption scenarios. This represents step function demand growth rather than gradual industrial expansion. Current global silver supply totals roughly 1 billion ounces from mining and recycling combined. Existing industrial applications already consume over 900 million ounces annually, creating structural deficits that have persisted for 3 consecutive years. Adding 100 million ounces of automotive demand to an already constrained market creates what materials scientists recognize as supply-demand inversion rather than cyclical imbalance. The solar industry compounds these pressures through continued rapid expansion. Photovoltaic manufacturing consumed over 200 million ounces of silver in 2024, with growth rates consistently exceeding 30% annually. Each solar panel requires silver paste for electrical connections that cannot be substituted without sacrificing efficiency. The global renewable energy transition mandates continued solar deployment regardless of materials costs under existing policy frameworks. Electronics manufacturing contributes additional demand pressure as devices become more sophisticated and data centers expand to support artificial intelligence applications. Military and aerospace industries require silver for advanced electronics and missile guidance systems. The cumulative effect across multiple massive industries creates unprecedented competition for available silver supply within overlapping timeframes. Mining companies cannot simply increase production in response to higher prices. Silver deposits require 7 to 12 years from discovery to commercial operation. Existing mines face declining ore grades that require processing larger quantities of rock to extract the same amount of metal. Environmental regulations complicate new project development across major producing regions under current permitting regimes. Political factors further constrain supply expansion. Mexico produces 25% of global silver, but has restricted new mining permits. Peru faces persistent labor strikes and social unrest that interrupt production. Russia remains subject to sanctions that limit market access. The geographic concentration of silver production in politically volatile regions creates supply vulnerabilities that cannot be easily diversified in the near term. Recycling provides limited relief from supply constraints. Unlike gold, which concentrates in jewelry and coins that facilitate recovery, silver disperses across countless industrial applications in quantities too small for economic recycling. Solar panels contain silver in thin films that cost more to extract than the recovered metal is worth. Electronic devices incorporate microscopic quantities spread across dozens of components spread across global consumer markets. Battery recycling won't provide meaningful supply for at least 15 years, as current installations haven't reached end of life. The silver that flows into solid-state batteries beginning in 2026 will remain locked in those applications until the vehicles are scrapped in the 2040s. This creates a temporal mismatch where demand increases immediately, while recycling supply emerges only decades later by design of product life cycles. The timeline disconnect between demand emergence and supply response guarantees years of structural shortage. Automotive companies need silver beginning in 2026 to meet announced production targets. Mining companies require until 2035 or later to bring significant new capacity online. The gap between industrial requirements and geological reality creates conditions where availability becomes more important than price in determining production schedules for manufacturers. Historical precedent demonstrates how markets behave when new technologies suddenly increase demand for materials with slow supply response. Palladium experienced similar dynamics in the early 2000s when automotive companies shifted to palladium-based catalytic converters. Prices increased from $200 to over $3,000 per ounce as industrial users competed for limited supply over a compressed period. What happened to silver over the holiday weekend represents more than market volatility or financial engineering. The $34 billion emergency injection was merely the visible symptom of a structural transformation that has been building beneath the surface of global materials markets for years. While headlines focused on price crashes and margin calls, the real story unfolded in procurement departments and manufacturing facilities where the basic assumptions about materials availability suddenly no longer applied in practice. The collision between advanced battery chemistry and geological reality has created conditions that traditional market mechanisms cannot resolve through price discovery alone. Physical scarcity has begun to override financial complexity. The mathematics of supply and demand are asserting themselves against the psychology of trading systems that were designed for an era of materials abundance that no longer exists under current industrial trajectories. The decisions being made right now by automotive executives, technology manufacturers, and government agencies reflect an understanding that the fundamental structure of materials markets has changed, regardless of what current pricing systems suggest. These are not temporary adjustments or cyclical corrections. They represent permanent adaptations to a new reality where the physics of scarcity determines industrial possibilities more than the preferences of market participants or the intentions of policymakers over the coming decade.